Okay, so imagine you're a real estate developer, right?
Right.
And you've got this great business going. You're building standard, reliable family homes.
Just, normal suburban subdivision.
Exactly. You've got a predictable rhythm.
Okay.
But suddenly, a group of frantic tech billionaires just kicks down your door.
Okay.
And they demand that you build like 100 sprawling, ultra-luxury mega mansions.
And let me guess, they need them yesterday.
Literally yesterday.
Okay.
So to pull this off, you actually have to bulldoze your entire existing subdivision.
Wow.
Yeah, you redirect every cement truck, every electrician, every single piece of drywall to these mansions.
Right, because that's where the money is.
Exactly. You make an absolute fortune on the mansions. But you've just created this massive systemic housing crisis for everyone else who's just looking for a standard home.
Because the supply is just gone.
Right. And the price of whatever regular houses are like on the market absolutely skyrockets.
Yeah, that makes sense.
Well, today, we are looking at a company that just did exactly that, but with the world's most critical AI hardware.
And they made a killing doing it.
A near 85% profit margin, to be exact.
Yeah.
So today, we're dissecting the Q3 2026 earnings call for Micron Technology, ticker symbol MU.
And I have to say, the scale of what is happening inside this company right now is, it's forcing analysts to completely tear up their financial models.
Because it's that unprecedented.
It really is. When you read through the transcript of this call with the CEO, Sanjay Mehrotra, and the CFO, Mark Murphy, you realize pretty quickly you aren't just looking at a good quarter.
Right.
You are looking at a fundamental rewiring of global semiconductor economics. The numbers they reported are frankly difficult to process without taking a step back to look at the broader historical context of hardware manufacturing.
Okay, well, let's jump right into those numbers, because as an investor, you need to hear this.
Yeah, let's hear the headlines.
For their fiscal third quarter of 2026, Micron reported revenue of $41.5 billion.
That's billion with a B.
Billion with a B. And just to put that into perspective for you listening, that is in a single 3-month period.
Right, a single quarter.
That represents a 74% sequential increase from the quarter prior.
Which is just staggering for hardware.
Right. A 74% jump in 3 months for a company manufacturing physical, tangible goods, not software.
Exactly.
And year over year, that revenue is up 346%.
So they've more than quadrupled the size of their business from exactly 1 year ago.
Yeah, the sequential dollar increase alone, which was a $17.6 billion leap, is the largest single quarter dollar jump in the history of the company.
It completely obliterates the record they set just last quarter.
Which was a $10.2 billion jump.
Right. But, you can sell all the volume in the world, but the metric that dictates whether a business has actual leverage is profitability.
Right. Revenues are vanity, margins are sanity.
Exactly. And their consolidated gross margin for Q3 came in at 84.9%.
Which is just insane.
It really is. That is a 10 full percentage point increase sequentially. It has more than doubled from a year ago.
And that flows directly to the bottom line, right?
Yep, giving them a non-GAAP diluted earnings per share of $25.11 for the quarter.
Unbelievable.
Which is a 106% sequential increase in EPS.
Okay, but hold on. I have to play the skeptic here for a minute.
Sure, go for it.
An 84.9% gross margin in hardware manufacturing. That breaks the conventional rules of business.
It definitely bends them.
Right, because if you are a software company, like, say, a Microsoft or an Adobe, sure. You write the code base once, you duplicate it infinitely with virtually zero marginal cost, and boom, you pull in 80+% margins.
Because there's no physical constraint.
Exactly. But Micron is building physical memory chips. They require multi-billion-dollar fabrication plants, highly specialized raw materials.
Incredibly fragile supply chains.
Yes, and legions of advanced engineers. To pull off margins like a sauce company, they must be starving the market of something else to drive prices up.
Which goes back to your real estate analogy.
Exactly. What exactly are they building that is eating up all this capacity?
Well, it really comes down to the physical, structural build-out of artificial intelligence infrastructure.
The AI boom.
Right. If you look at their business unit breakdown, the cloud memory business unit hit $13.8 billion.
Okay.
And the core data center business unit hit $11.5 billion.
So combined, they're doing over $25 billion in data center memory in just 3 months. Wow.
That places their data center business alone on an annualized run rate north of $100 billion.
That is massive. Yeah. What is driving that specific segment so hard?
The management team pointed to a very specific catalyst on the call. It's the industry-wide shift toward agentic AI.
Agentic AI. Okay, let's translate that for the listeners.
Yeah, so we've moved past the initial phases of AI, right, where you type a prompt and a large language model just spits back a text response.
Like early chat GPT.
Exactly. We are now entering the era of autonomous agents.
Right, systems that don't just answer questions, but they actually execute complex workflows.
Right, they take action.
Like, you give an AI agent a high-level goal, like research these 10 competitors and build a financial model.
And the agent just goes out and does it.
Right. It browses the web, interacts with software tools, compiles data, and it even iterates on its own mistakes.
But to do that, the AI needs an absolutely enormous context window.
It has to remember everything it's doing.
Exactly.
Right.
It has to hold the initial instructions, the web pages it just read, all the intermediate data, and the final output, all in its active memory simultaneously.
And that active memory, structurally speaking, is DRAM.
Yes. And this context window expansion is the critical bottleneck. Well, when you increase the context window of a model from, say, 100,000 tokens to 1 million tokens, the memory capacity required doesn't just scale linearly.
It scales exponentially.
Yes. The bandwidth required to feed that massive amount of data into the processing cores scales exponentially.
Okay, so it's not just about having the data, it's about moving it fast enough.
Right, because if the compute cores inside, say, an NVIDIA or AMD accelerator, are just sitting idle because they are waiting for data to arrive from memory,
Then the entire system is bottlenecked.
exactly, you are wasting incredibly expensive compute power.
And nobody wants to waste time on an NVIDIA GPU right now.
No, they don't. So this insatiable appetite for memory bandwidth is driving the adoption of HBM across the entire data center ecosystem.
Okay, HBM, that term was mentioned dozens of times on this call.
High bandwidth memory.
Right, so let's break this down. Think of standard legacy memory, like a really fast sports car on a single-lane highway.
Okay, I like that.
It's quick, but it can only bring so much data to the processor at once. If you have a massive AI model trying to pull gigabytes of weights and parameters, that single lane gets backed up instantly.
Right, a massive traffic jam.
Exactly. So HBM is like building a 12-story, 100-lane superhighway directly attached to the processor.
Yeah, that's exactly what it is.
It's not just about the raw speed of the individual cars. It's about the sheer volume of traffic that can flow simultaneously into the compute cores.
And the mechanism behind that 100-lane superhighway is where the actual manufacturing complexity lies.
Because it's not a normal chip.
No, HBM is not just a different type of chip. It is a fundamentally different architecture entirely. It involves 3D stacking.
3D stacking.
Right. Micron is currently ramping up a product called HBM3E, and they're moving towards an even more advanced version called HBM4.
Right, I saw that in the transcript.
The CEO mentioned their HBM4 12 high, meaning they are taking 12 individual layers of DRAM memory and stacking them vertically, like a high-rise building.
Okay, but how do they connect them? I mean, they're just stacked on top of each other.
Well, to get those layers to communicate, they literally have to drill microscopic holes straight through the silicon.
Straight through the chip itself.
Yes. These are called through silicon vias, or TSVs, and they fill them with copper.
Okay, drilling microscopic holes through highly fragile silicon wafers.
Yep.
And stacking them 12 high without breaking them or causing microscopic alignment errors. That sounds like a manufacturing nightmare.
It is arguably one of the most difficult processes in modern manufacturing.
And I can't even imagine.
You have to align these TSVs perfectly across all 12 layers, and then you have the thermal challenges.
Oh, because of the heat.
Right. When you stack 12 layers of memory on top of each other and run data through them at terabytes per second, they generate an immense amount of heat.
And you can't just put a fan on it.
No, you can't. Dissipating that heat so the chip doesn't literally melt itself requires highly advanced packaging and proprietary underfill materials.
I imagine the defect rate is pretty high.
Exactly.
Yeah.
Because this process is so intricate, the defect rate is naturally higher than manufacturing a standard flat 2D memory chip.
So if one layer fails,
If one layer in that 12 high stack has a critical flaw, you often have to scrap the entire stack.
oh wow, so you lose all 12 chips.
Right. This means your initial yield, the percentage of usable chips you get from a silicon wafer, is significantly lower.
Which brings us right to the core of the capacity issue.
The bottleneck.
Right. Because making HBM is so difficult, and because the yields are lower, it eats up a disproportionate amount of factory floor space.
Yes.
And this is the concept management referred to on the call is The trade ratio, right?
Exactly. The trade ratio is the single most important metric for understanding the current supply squeeze.
Let's unpack that.
So making a single gigabyte of HBM takes up significantly more cleanroom space and requires far more silicon wafer starts than making a gigabyte of standard DDR5 memory for, a laptop or a standard server.
So it's basically crowding out the normal chips.
Completely. Micron and their competitors are physically constrained by the square footage of their ultra-clean manufacturing facilities.
They only have so much room.
Right. So to meet the frantic demand from cloud providers for HBM, they are forced to dedicate massive swaths of their factory floor to it. They are actively redirecting cleanroom space away from standard DRAM and NAND production.
Which loops us right back to the mega mansion analogy from the intro.
Yes.
By chasing the ultra-high margin HBM for AI, the mega mansions, they have purposefully choked the supply of normal memory for PCs, smartphones, and regular servers.
They literally do not have the physical factory space to build both at scale.
So the inevitable result is an industry-wide shortage of standard memory.
And the pricing data from the call validates this perfectly.
What do the numbers look like there?
In Q3, their standard DRAM prices increased in the low 60s% range.
Wow.
And their NAND prices increased in the mid-80s% range.
Just for standard memory.
Just for standard memory.
Yeah.
And this wasn't driven by some sudden massive spike in consumer demand for laptops or smartphones.
Right. Nobody's rushing out to buy 3 laptops right now.
Exactly. It was driven purely by tight industry supply and a favorable product mix. The supply is choked off at the source, so prices skyrocket across the board.
It's just simple supply and demand at that point.
And that dynamic is the engine generating their 84.9% gross margins.
Okay, but wait. I've got to stop you there. Basic economics dictates that the cure for high prices is high prices.
Right.
If memory gets this expensive, hardware manufacturers for laptops or automotive systems, they will eventually balk.
They'll push back.
Yeah.
Yeah.
They will stop buying, or they will delay their product cycles until prices come down.
Which is what usually happens.
Exactly. In historical hardware cycles, the classic memory boom and bust prices spike. Companies overbuild factories to capture the profits, supply floods the market, and then prices absolutely crater.
The classic cycle.
Right. So what stops this cycle from collapsing under its own weight the moment AI demand normalizes?
That vulnerability is exactly what the industry has struggled with for decades. It's known as the pork cycle.
The pork cycle.
Yeah. But Micron's management team has aggressively re-engineered their business model to insulate themselves from that exact scenario.
How so?
They announced the signing of 16 strategic customer agreements, or SCAs.
Okay, I saw this in the transcript. This is huge.
It's massive. 4 of these are with the massive hyperscale cloud providers, 3 are with medium-sized tech players, and the rest are spread across smaller customers, heavily concentrated in the automotive sector.
Okay, so these SCAs are essentially take-or-pay contracts.
Yeah, essentially, yes.
But I really want to push back on how ironclad these really are.
Okay, what's the concern?
We saw this exact same movie play out in the late 1990s with Cisco during the dot-com bubble.
Ah, yes. The telecom bust.
Right. Telecom companies were so terrified of running out of routers and switches that they signed massive long-term purchase agreements.
Just hoarding equipment.
Exactly. But when the bubble popped and the telecom companies went bankrupt, those contracts weren't worth the paper they were printed on.
Because you can't get blood from a stone.
Exactly. So if the AI bubble bursts and these mega cap tech companies suddenly realize they overbuilt their data centers, won't they just break these contracts? Just walk away and pay the penalty?
The risk of default is always present in any contract, sure. But the structure of these SCAs, combined with the financial profile of the counterparties, makes this a very different scenario than the telecom bust.
How so?
First, look at who the 4 largest customers are. While management doesn't name them explicitly, it is universally understood we are talking about companies like Microsoft, Google, Amazon, and Meta.
The Magnificent Seven.
Right. These are companies sitting on tens of billions of dollars in free cash flow themselves. They are not highly leveraged, speculative telecom startups.
That's a fair point. They have fortress balance sheets.
Extremely strong.
They aren't going to go bankrupt just because they overordered some memory chips.
Furthermore, to secure these SCAs and prove they aren't just phantom demand, these customers have fronted massive amounts of capital.
Wait, they paid up front?
Yes. Micron reported that they have received $22 billion in customer deposits and financial commitments.
$22 billion.
$18 billion of that is unrestricted cash sitting on Micron's balance sheet right now.
Wow, just sitting there.
And The remaining $4 billion is held in letters of credit.
So they essentially funded Micron's expansion for them.
Exactly. The customers have essentially handed Micron the cash up front to fund the expansion of the very factories that will build their chips.
So even if the customer wanted to walk away, Micron is already holding $18 billion of their cash.
Good luck getting that back if you break the contract.
Right. But let's get into the actual pricing mechanics of these SCAs, because this is where the boom and bust cycle really gets neutralized. You mentioned floor and ceiling prices earlier.
Yes. This is brilliant on management's part. For the largest segments of these agreements, the contracts define a ceiling price and a floor price.
Okay, so the ceiling first.
The ceiling price acts as an insurance policy for the tech giants. It is capped at Q2 market prices.
Got it. So if the memory shortage gets even worse, the hyperscalers know their costs won't spiral to infinity.
Right. They have locked in a maximum cost, allowing them to confidently forecast the build-out of their multi-billion-dollar AI data centers without pricing shocks.
Okay, so the ceiling protects the buyer. But the floor price is the real story here for Micron investors.
Absolutely. The floor price protects Micron.
How does that work?
If the broader memory market crashes, if supply suddenly outstrips demand and spot prices plummet by 50%.
Which is the typical bust scenario.
Right. Even if that happens, these tech giants are contractually and legally bound to continue purchasing their massive, committed volumes of memory from Micron at the predetermined minimum floor price.
And where is that floor set?
Well, Sanjay Mehrotra explicitly stated on the call that the gross margins generated at this absolute worst-case scenario floor price are, quote, well above our peak quarterly margins in any past cycle.
Wait. Let that sink in for a second.
That's wild.
The absolute worst-case scenario, the bottom-of-the-barrel bust cycle under these contracts, yields profit margins that are higher than the absolute greatest boom times in Micron's 50-year history.
That is exactly what they're saying.
They have effectively established an artificially high profitability floor.
And we aren't just talking about a few quarters of protection here.
How long does this last?
Well, under strict ASC 606 accounting rules, which dictate how companies must report revenue from contracts with customers, Micron is required to disclose their remaining performance obligations, or RPO.
And ASC 606 is not something you can just fudge.
No, it is extremely strict. This isn't marketing fluff. This is audited, legally binding future revenue based on the minimum committed volumes and the absolute minimum floor prices.
So what is the number?
Across 14 of the 16 SCAs, Micron has locked in a cumulative minimum future revenue of $100 billion.
$100 billion. Guaranteed revenue.
Locked in.
Locked in at margins higher than any previous historical peak.
Exactly.
Because, like you said, before ASC 606 accounting allows you to book that, the auditing standards demand rigorous proof that the revenue is highly probable and the contracts are enforceable.
They have to prove it's real.
This effectively transforms Micron from a highly cyclical, volatile hardware commodity player into a predictable, high-margin, locked-in revenue engine.
It really is. It is closer to a massive multi-year enterprise software subscription model than a traditional hardware cycle.
It completely de-risks the stock from a long-term investment perspective, doesn't it?
It absolutely does. But it does raise a critical operational question.
Which is?
If you have a guaranteed $100 billion in demand and your customers are literally wiring you $18 billion in unrestricted cash just to hold their place in line,
why on earth doesn't management just take that cash and build 10 new factories tomorrow?
Right. Why not capture even more of the market and accelerate that revenue?
And that brings us perfectly to the Q4 guidance and the stark realities of semiconductor manufacturing.
Let's talk about the guidance.
Mark Murphy, the CFO, guided for a record $50 billion in revenue for Q4, plus or minus $1 billion.
Just phenomenal numbers.
They expect gross margins to expand even further to roughly 86%. And EPS is projected at an unbelievable record of $31 per share.
Record after record.
So again, to your point, if you are printing $31 a share and grossing 86%, why the intense warnings on the call about supply constraints? Management was adamant that supply will remain tight beyond calendar 2027. Why can't they just scale up?
Because building a leading-edge semiconductor fabrication plant is arguably the most complex, capital-intensive manufacturing endeavor in human history.
It's not just slapping up a warehouse.
Not at all. You cannot simply squeeze more output from existing facilities. You have to build what the industry calls greenfield fabs.
Right, greenfield, meaning you are starting from a literal empty field of dirt.
Exactly. You aren't upgrading a brownfield existing factory.
You are breaking ground, pouring massive concrete foundations to isolate vibration, and building the infrastructure from absolute scratch.
And the constraints on building greenfield fabs are multifaceted and severe.
What are the main bottlenecks there?
Sanjay Mehrotra detailed these globally. First, the construction lead times are immense. You have to build massive, ultra-pure clean rooms.
And when we say clean, we mean
the air inside these rooms must be thousands of times cleaner than a hospital operating room.
wow.
Because a single speck of dust landing on a wafer during lithography can destroy an entire batch of chips.
So the building itself is a technological marvel.
And to run these fabs, you need incredible amounts of resources. We are talking millions of gallons of ultra-pure water a day for chemical rinsing.
Billions of gallons.
And power consumption equivalent to a small city.
Just to run the fab.
Yes. You have to navigate labyrinthine environmental regulations, secure water rights, and build dedicated power substations just to plug the factory in.
That takes years before you even put a machine inside.
Exactly. And the labor constraint is equally tight.
Like finding the right engineers.
Even before that, there is a severe global shortage of the specialized tradespeople required to weld the ultra-high purity plumbing systems.
The pipes that carry the chemicals.
Right, pipes that carry highly corrosive chemicals and gases throughout the fab. You can have all the cash in the world, but if you don't have enough specialized pipe fitters and electricians, the building timeline just stretches out.
Okay, so where is Micron actually allocating capital to build right now?
Yeah.
What is the real world timeline for new supply hitting the market?
Well, they're heavily focused on U.S. leading-edge DRAM manufacturing, supported in part by the CHIPS Act.
Right, bringing manufacturing back stateside.
Yes. They have two massive fabs under construction in Boise, Idaho, known as ID1 and ID2.
Okay.
And they just broke ground in January of this year on a massive fab cluster in Clay, New York.
So they are building, but when do these actually turn on?
Here is the reality check on the timeline. Despite billions of dollars in CapEx and government support, the Idaho Fab ID1 will not output its first production wafer until mid-calendar 2027.
Mid-2027. And we're in mid-2026 now.
Right. And ID2 will not output its first wafer until late 2028.
Wow. Mid-2027 just for the first wafer out the door.
Just the first wafer?
And it's crucial to understand for anyone listening that a wafer doesn't become a chip overnight.
No, it's a long process.
The manufacturing cycle time, the time it takes for a blank silicon disk to go through the thousands of individual chemical etching, deposition, and photolithography steps takes months.
Months.
So the wafer finishing in mid-2027 doesn't translate into packaged, tested HBM chips hitting a data center server until late 2027 at the earliest.
Exactly. And that is just the physical construction of the building. The technology going inside the building is also getting exponentially harder.
How so?
As they move to their 1-gamma DRAM node and their G9 NAND node, they are forced to transition to extreme ultraviolet lithography, or EUV.
Ah, EUV. Let's talk about EUV, because this perfectly illustrates why supply is fundamentally constrained by the laws of physics.
It really is science fiction stuff.
Yeah. To print transistors that are only a few atoms wide, you need light with an incredibly short wavelength. Standard lasers just don't work anymore.
Exactly. EUV light doesn't even exist naturally on Earth. It gets absorbed by air.
So how do they even make it?
To generate it, these machines take a microscopic droplet of molten tin, drop it into a vacuum chamber, and blast it with a high-powered industrial laser twice in rapid succession.
Wait, they shoot a drop of falling tin with a laser?
2 lasers. The first pulse flattens the tin into a pancake. The second pulse vaporizes it into a plasma, which then emits the EUV light.
That is insane.
And then that light is bounced off a series of incredibly flawless mirrors to project the chip blueprint onto the silicon wafer.
It sounds totally like science fiction, but it happens, what, 50,000 times a second inside these machines?
50,000 times a second, yeah.
And only one company in the world makes them, right?
Right, ASML, based in the Netherlands.
And these EUV machines cost hundreds of millions of dollars each. They are the size of a double-decker bus.
It requires multiple Boeing 747s just to ship one of them.
Which means ASML can only build a few dozen of them a year.
Exactly. So even if Micron had the factory built today, they are entirely dependent on the incredibly constrained global supply chain for these lithography tools.
You literally have to wait in line for the machines that make the chips.
Yes. And the transition to EUV means every new generation of memory is harder to shrink.
Because we're hitting the physical limits of atoms.
Right. The historical cadence of Moore's law, where you could easily double the density of chips every 2 years, has slowed to a crawl.
So you get fewer gigabytes of memory per wafer.
You get fewer gigabytes, and the tools take up more clean room space. So the technological difficulty of shrinking the transistor acts as a massive headwind on the total output capacity of the industry.
You have structural supply constraints colliding with locked-in exponential AI demand.
Which is the perfect storm for profitability.
Right. This synthesis is exactly why the gross margins are sitting at 85%.
Yes.
You have a scenario where demand is legally mandated for years via the SCAs, big tech is forced to buy, and they have agreed to high margin floor prices.
And on the flip side,
on the supply side, output is artificially choked by the laws of physics, the agonizingly slow complexities of greenfield fab construction, the global bottleneck of ASML's EUV machines, and the massive amount of factory floor space that HBM requires.
It is the ultimate recipe for sustained multi-year pricing power.
It really is, which naturally leads to the most important question for an investor looking at the stock today. What is management going to do with the unprecedented amount of cash this dynamic generates?
It's a great problem to have.
Right. I mean, they produced $18.3 billion in free cash flow in Q3 alone. Where's that capital going?
Right, because generating cash is great, but capital allocation is what determines shareholder returns.
They're clearly investing heavily in CapEx, right?
Yes. Mark Murphy projected around $10 billion for Q4 and $27 billion for the full fiscal year 2026.
$27 billion on factories and machines.
But even with $27 billion in capital expenditures, they are pulling in so much revenue at 85% margins that they're going to have a massive surplus.
So what's the plan for the surplus?
Mark Murphy dropped a definitive signal on the call regarding that. He noted that starting December 9th, 2026,
which coincides with the 2-year anniversary of the signing of their CTPS Act agreements, right?
Exactly, the agreements with the U.S. government. Starting on that date, Micron plans to dramatically increase capital return.
Meaning dividends or buybacks?
Yes. His exact phrasing was that they expect to return 100% of their excess free cash flow to shareholders over time.
100% of excess free cash flow returned to shareholders?
Yes.
We are talking about a company generating tens of billions of dollars a quarter.
It's a fundamental shift.
When a massive hardware company transitions from a pure growth and reinvestment phase into a phase where they are returning 100% of free cash flow, it fundamentally changes the investor base.
Like Apple did.
Exactly. We saw this with Apple under Tim Cook. Once Apple saturated the smartphone market and started generating more cash than they could possibly deploy into R&D, they instituted massive buyback programs and dividends.
And that completely changed how Wall Street valued them.
Right. That capital return program put a floor under the stock and drove years of compounding returns for shareholders.
Micron is setting up a very similar dynamic, but fueled by AI infrastructure rather than consumer electronics.
And whether that return comes in the form of massive special dividends or incredibly aggressive systematic stock buybacks, that is a tidal wave of capital flowing directly back to the investors.
And let's not forget the balance sheet strength providing the foundation for this either.
What do you mean?
That $22 billion in customer deposits.
Right, the cash the hyperscalers gave them.
While they will eventually return those deposits as credits in the back half of the multi-year agreements in the near to medium term, that provides immense liquidity.
It's basically an interest-free loan from your biggest customer.
Exactly. The credit rating agencies have already recognized this transformation too.
Oh, did they get upgraded?
Yeah, Micron received credit rating upgrades from all 3 major agencies this year to BBB plus Bell, and they reduced their debt by over $4 billion just in Q3.
So the balance sheet has never been stronger.
Never. Which protects them from macroeconomic shocks while they execute this massive CapEx build-out.
When you look at the fundamental mechanics of the business today versus 5 years ago, the risk profile has been entirely inverted.
Totally flip.
The multi-year take-or-pay contracts have established a profitability floor that simply did not exist in the past.
No, they used to just guess at demand.
Right. Now, they can confidently spend $27 billion in capital expenditures because their largest customers have already legally guaranteed they will buy the resulting output at highly profitable margins.
Visibility into their own future revenue is better than it has been at any point in the company's nearly 50-year history.
Which brings us to the bottom line. If you are holding or considering MU right now, you have to recognize that the rules of the game have changed.
They absolutely have.
For decades, memory was a cutthroat commodity. You built a fab, you pumped out DRAM, you hoped someone wanted it for a PC or a server, and you fought your competitors on fractions of a penny.
A race to the bottom.
But today, Memory is a highly specialized, absolutely critical bottleneck for the most important technological arms race of our lifetime.
Micron is no longer a passenger on the cyclical tech roller coaster.
They own the tracks, and they are driving the toll booth.
Exactly. The narrative that Micron is a boom and bust trap is just outdated at this point.
Yeah.
The sheer physical complexity of making AI memory has choked supply, and the $100 billion in binding contracts has locked in demand.
They hold unprecedented pricing power.
And they have the contractual floor prices to defend it, even if the broader market wobbles.
Well, before we wrap up, I want to leave you with one final fascinating detail from the call to chew on.
Oh, the robotics comment.
Yes. We spent this entire deep dive talking about data centers, cloud providers, and the massive server racks powering large language models.
The stuff happening behind the scenes.
Right. But tucked away in the prepared remarks, CEO Sanjay Mehrotra mentioned the next frontier: physical AI, robotics.
Which is going to be massive.
As advances in foundational models accelerate, the industry is preparing to move AI from the server rack into the physical world. And he noted a staggering statistic on the call.
It blew my mind when I read it.
The humanoid robots currently in development will require 10 times the amount of memory as a highly advanced L2 plus autonomous vehicle.
10 times the memory of a self-driving car, just for one individual robot.
It makes sense when you think about it.
It does. When you think about what a humanoid robot has to do perceiving its dynamic environment in 3D space, running real-time inference on complex motor controls, recognizing objects, and understanding contextual commands.
And doing it all simultaneously without killing anybody.
Exactly. All of that requires massive amounts of local, high-bandwidth memory embedded directly in the robot.
It can't rely entirely on a cloud connection because the latency would cause it to fall over.
Or crash into a wall. It has to think locally.
Which creates a massive multi-decade memory demand cycle that hasn't even begun to hit the balance sheet yet.
No, this isn't even in the current numbers.
The data center build-out we are seeing right now is literally just the first wave.
Just the beginning.
So as you watch this AI boom expand from the cloud into physical robotics over the next decade, you have to ask yourself, with supply so physically difficult to build and demand expanding into entirely new sectors of the physical economy, is memory essentially the new oil of the 21st century?
It certainly looks that way.
Because right now, Micron is sitting on a gusher, and they have the $100 billion in contracts to prove it. Keep learning and keep looking behind the numbers.